and welcome to Foyst & Gordon & Payne's 2025 Review and Outlook for 2026. My name is Mimi Majimder, and I'm a Principal Client Relationship and Business Development Manager at FGP. For the next 25 to 30 minutes, I will be your moderator as we do a retrospective of the broad economy and specific markets in 2025 and consider the expectations for 2026. Joining me today to share their insights on these topics are three members of our investment team. Brian Pillsworth, our President and CEO and Head of Canadian Equities, Cam Greenwood, Senior Vice President, Portfolio Manager, and Co-Chair of our Investment Committee, and Andrew Okwan, Senior Vice President, Portfolio Manager, and Head of Global Equities. Gentlemen, thank you for sharing your time today, and a welcome and Happy New Year to our webcast audience. We are recording this webcast on January 12th, and so while we've had some time to digest the outcomes of 2025, perhaps over the holidays, over some turkey and fruitcake, we've only yet had 6 business days in 2026 from which we can gauge our expectations. When looking back at when we did this recording this time last year, the questions that swirled were materially different than what we'll be talking about today. As always, I've focused on a few key questions, but of course, you're more than welcome to share your thoughts on anything that you think would be interesting to our webcast audience. So to kick things off, I'll turn to our first panelist, our Investment Committee Co-Chair, Cam Greenwood. Cam, thinking back to this time last year, the major topic of discussion was what will happen with the U.S. administration in their first days in office. Well, we saw how the answers to that played out in the first half of last year. And for the most part, the market really took it in stride. What would you say were the aspects to that resilience in the market?
2025 was an interesting year in many regards. Despite all the noise and all the barrage of attention-grabbing headlines, actually, as you say, most corners of financial markets remained relatively resilient, and returns were strong, and in some cases very, very strong. That might be a bit of a surprise to some viewers today that are aware that growth did moderate in most regions across the world. We certainly saw labor markets cool throughout the year. We saw inflation really follow a bit of an uneven path. As we remind our clients pretty regularly, even though financial markets can be influenced by global economies, they're not the same thing. They are two separate entities, and they don't always move in a one-for-one fashion. And this past year was a great example of that in 2025. I think these two are going to talk a lot about returns in some of their answers, so I don't want to steal all their thunder, but I did want to provide a few data points for our listeners today. We have a graphic to show just visually how strong some of the returns will be. So from left to right, we have, all returns in Canadian dollars. We have the TSX, the main equity index here in Canada, up about 32%. We have the MSCI EFI index. That's really mostly the rest of the developed world outside of North America. That was up about 25%. The S&P 500 down in the US, 12.5%. A little bit more moderate in corporate bond markets, but still single-digit returns. So a very strong year. That built on a strong 2023 and 2024. So, in 2025, what drove that? It's still positive growth. It's mostly milder inflation, and it's resilient corporate earnings. That's really what drove the returns we saw in 2025.
I'd say that in some cases, that was perhaps maybe a surprise at the strength of the equity market returns in 2025. But moving away from specifically on the equity markets, let's turn to the debt markets. So in 2025, what we saw was a divergence of the central bank policy in Canada and the US. Can you talk a little bit about what is the impact of that divergence?
Yeah, absolutely. I'm going to keep this one a little short so these guys have a chance to talk. But Canada and the U.S. are closely linked. Our economies are closely linked. But we do see periods of divergences like we saw in 2025. So it's no secret that this is a challenging period for the relationships between our two countries from a trade perspective. Unfortunately, the Canadian economy has felt the impact to a greater degree of the uncertainty around trade. We are a smaller, open economy, and we felt the impact. As a result of this, our central bank, the Bank of Canada, were more aggressive in reducing their policy rates to help support, both economic growth but also price stability in the quarters to come. So they cut rates more aggressively than their U.S. counterparts at the U.S. Federal Reserve. So that has an impact at the front end of yield curves or fixed income markets. When I say front end of yield curve, I mean shorter dated bonds. So you can think 5 years and under. As a result, our yields are about 100 basis points lower or 1% lower than that we see in the U.S. Treasury market. So a rather significant divergence over the course of the year. As we look through into 2026, we'll have to see how the expectations of moves to come from the central banks will shape policy. But that's where we sit today.
Thank you. Cam, we're going to circle back to you talking about expectations in 2026. But before we do that, I'm going to turn to both Brian and Andrew to ask, and we'll start with Brian, to ask the question around within the equity market and specifically within Canadian equity market. When looking at the characteristics of where we are today, can you compare that to 2025? What happened in 2025 that may have been different than where we are today?
Well, I guess if we were doing this call a year ago today, it would be rather remarkable to predict that the TSX would have been one of the very best performing equity markets in the world. So we have had a really exceptional year. What's happened in 2025? Again, Cam was talking about stock markets aren't necessarily the economy, and the Canadian TSX has a number of sectors that had good performance. Clearly materials was the top performing sector. Precious metals companies and other companies as well did very, very well, grew their earnings and also had valuation expansion. The other really standout was financials and in particular the banks. So a number of banks had very strong returns this year. Again, a combination of earnings growth, which was really, really good. And also the valuation has expanded as well. When banks typically grow their earnings and analysts take up their estimates, the valuation expands. Last year I was talking about, and I have been making the case to our clients, that Canada was very inexpensive relative to other global markets, in particular the U.S. market, and that's narrowed definitely. Our Canadian market has gotten more expensive, but as I'll probably allude to earlier, our portfolio is positioned to be better value than the TSX. So we still think that there's some room for catch up. So I've talked about financials, I've talked about materials, but there's been other sectors as well that have had re-ratings as well. So earnings growth is a key driver and expectations have gone up. So I think those are kind of the big things that happened in 2025.
Andrew, same question for you. When you compare 2025 to where we sit today, what insights would you share?
I'd echo some of the points Brian just made, around that we saw a really strong performance across global equity markets. This is the third year of consecutive double-digit returns that we've seen, and it's really quite impressive. And it's really been, the valuation re-rating and also earnings growth. We would have said a year ago that the difference between global markets and the U.S. market specifically, that there was a wide difference in valuation there. So over the last year, we've seen better performance out of these markets in Europe and in Asia. And so some of that valuation premium of the U.S. has narrowed, and we've seen some of these markets increase. So across all markets globally right now, we're sort of sitting at the higher end of historical valuation ranges. And so that has been a key driver of the performance over the last couple of years.
We're going to circle back, Andrew, on a little bit more, but I'm going to actually, coming back, Brian, you'd mentioned this around just what an outstanding year the TSX has had. And when you think of value and finding value within Canada and within that market, how would you say you're able to, specifically in your portfolio, closely match those benchmark returns?
Yeah, so very good point. I think one thing that's worth emphasizing is that Canada is a core component of any diversified portfolio, and it really expressed itself as you had to be in Canada to have great returns last year. Certainly there are great returns in a lot of equity markets, but it just emphasized, in our view, the returns that we got last year, that Canada was undervalued. And there's a lot of sectors that were benefiting, frankly, from some of the things that have been changing over 2025. We did have an exceptional year. 2025 was the best year since 2009 in the Canadian stock market. So this isn't going to be, I would caution highly that this is not going to be a recurring event to have years where you have kind of these really, really strong returns. But that being said, I think the setup for 2026 is good. It's favorable, and we can still see a situation where we can still get earnings growth from a number of the sectors, and probably some multiple expansion. The other thing that I would highlight as well is that Canadian companies in general are very good dividend payers. And so that contributes to the returns, even when times are good or bad. So in terms of where we're seeing value, I mean, I think there's a few sectors and some obviously stocks that I'm not going to talk about in this interview, but sectors where there is good value. I mean, number one, I think the energy sector actually has very good value right now. The Canadian companies, there's been a lot of news flow on the energy sector, but the Canadian companies are doing great at lowering their costs, lowering their debt, and just getting more efficient. And the multiples there are not very high. So I think that's very good. Another sector, which is maybe a little contrarian, is the communication sector. You know, we've had a number of our telecom companies that have faced pressures. You know, their balance sheets have been a little stretched. They're working on reducing that. Valuations aren't too demanding, and expectations, frankly, are low. So I think there's value there. There's also other parts, maybe a little more idiosyncratic, specific companies that offer value. So I think even when the market is frothy, if I can use that term, you can still find value. But I think it's also important to mention that we stick to our strategy. The quality of a company is so critical, and sometimes the valuation will expand a bit, but you've got to always look at quality and value. So you don't want to have what I would call a knee-jerk reaction and change just because the news this week is X. You got to stay to your long-term strategy, stay with the quality companies, have good valuations you always try to get, and good dividend payers as well. And regardless of what the market is, whether it's good or bad, that will serve to generate long-term consistent returns. Again, we'll see what happens, but I think it's important to remember, though, expectations, I think, should be tempered a little bit on a go-forward basis.
Brian, thank you. You re-emphasize that FGP really are fundamental bottom-up investors. And yet, that said, I don't think we can do this webcast without addressing the global environment. And so, Andrew, I'm going to turn to you with the question around our current global environment. And given everything that's happening in the world, how do you see that moving forward into 2026? Are there any dynamics that investors should be aware of?
Yeah, I mean, I'd highlight a couple points that I think both Cam and Brian brought up. One is Cam's point earlier that there is a difference between financial markets and the economy and what's going on in the world. And as evidence of what's just happened in 2025, those two can produce different results over a period of time. I'd also highlight that we're long-term investors. And so we really think about returns from the perspective of the value that we're paying for those businesses that we're buying, and then the earnings power of those businesses. And so if we think about those two components for global equity markets, valuations right now across a lot of developed markets are above average and near historical highs, especially if we look at something like the US. We'd contend that if you think about forward returns in the future, that more of the return is going to be coming from the earnings of those underlying businesses, which is back to the point that we've been making, that really understanding the businesses and investing in quality businesses with durable earning streams is really what's going to, over the long term, produce returns if those are bought at attractive valuations. And we don't own the market. We own concentrated portfolios where we have high conviction in the businesses that we are invested in. And so we think there's always an opportunity to invest in companies at a discount to what we think they're worth, and we're looking for those businesses to generate earnings over time.
We're going to switch tracks for a moment, and then we're going to circle back to fixed income. So, Cam, can you talk to us a little bit about the health of the corporate bond market? We're currently seeing spreads that are at some of the tightest that we've seen in a long period of time. Do you have any insights that you can share with us? Is this the right time, for example, for investors perhaps to be looking at high yield securities? Any thoughts that you can share on that?
There's a couple different ways I think I could go with this question. Some of the comments will be more aligned with these two are talking about, because an investment in a corporate bond in terms of the fixed income context is more along the lines of an equity investment than a purely fixed income note. So the same tenant, underlying tenant. So the corporate bond market, like Brian said about the TSX in Canada, the Canadian corporate bond market had a very strong year spread-wise. So you pointed out correctly, spreads are at very, very tight levels, corporate credit spread. So credit spread, just for the viewer that might not be completely aware, it's a measurement of risk in the market. So the wider the corporate spread, the more the investor's getting compensated to take on additional risk. The tighter the credit spread, the lower the compensation, also a valuation metric. When they're low, the valuation in the market is generally high. So right now, that's where we are. And the spread between, what I'll call stronger fundamental corporate investments and weaker fundamental credit investments is pretty narrow. So you're not getting compensated for taking the extra risk in credit portfolios, in our view. That doesn't mean there's not opportunities in certain parts of corporate credit markets, but you have to be very selective in markets like we are in today. Not only just credit spread specifically, corporate issuance actually has been really, really strong. In North America, I'll say specifically for many quarters now. Both, the number of issues, the number of types of issuance, unique corporate issuers being able to raise. When I say issuance, that's where companies, primary market, where they raise capital to fund business operations. So we're seeing unique corporate issuers. We're just seeing the size of issuance being very, very large. There's been a number of, more so in the US, but some really, really large corporate issuance. These things happen when credit markets are open, when they're functioning well. I don't want to sound too pessimistic, but for us, it's starting to lead to some uneasiness or some question marks around valuations in certain corners of markets. And to be completely transparent, we've used a lot of what's happened in the last number of quarters as an opportunity to reduce risk out of our fixed income portfolios across mandates that we manage for our clients. This isn't being done every single day, every single opportunity, but there are opportunities to meaningfully reduce risk across our portfolios without giving up too much income generation, which is a nice balance. But we got to be ready to take advantage of those opportunities when they present themselves.
So let's tie all this together. Cam, in your role as a co-chair of our investment committee, we are looking at, for example, an investor that maybe invested in a multi-asset portfolio. What would you say is the outlook for 2026?
So all these answers so far are specific for an asset class. So this one, you want me to think broader, whole portfolio. I think the first thing I would say, maybe for a multi-asset class portfolio, one, despite all, I think the uncertainty and challenges, we've talked about, fundamentally, we're not doing anything different. Our process hasn't changed, right? When it comes to portfolio construction for a multi-asset class portfolio, we really do believe in tailoring the long-term strategic asset allocation to meet both risk and return objectives of specific client, right? And these multi-asset class portfolios that are made up of investments in different asset classes really have two layers of embedded active management. One is at the overall portfolio level, right? Which strategies or funds are used in which weights to meet those risk and return objectives. And then the second layer is at the underlying strategy level, where Brian as a portfolio manager, Andrew as a portfolio manager, are managing these mandates to control risk, to generate return against their specific benchmarks, right? So that's the two layers of active management within a multi-asset class portfolio. And we do this to produce those, consistent and repeatable risk-adjusted returns for clients across, I think, many different market environments and cycles. So we're not looking to bet on a very short term, this may happen if these certain circumstances exactly line up, then we'll benefit. We're looking much longer term, right? Mm-hmm. Much broader, much more repeatable and consistent. We're in this world where growth is moderated. Policy rates are or already have approached neutral. There's uncertainty around trade, fiscal sustainability. One thing we haven't talked about yet, the durability of AI driven investment. There's quite a lot of cross currents that can shape this year. Take it in a different path depending on the outcomes of a number of different scenarios. 2025, we've all mentioned, it generated very strong returns, right? 2026, I think it's fair to say we all expect generally positive returns, but I think we're going to, as Brian said, we're going to struggle to match the returns of the previous year. So if we add, the expected, lower return in the coming year to the ongoing uncertainty, I think caution is reasonable as we head into 2026 for an overall multi-asset class portfolio. So what does that mean? We don't have any large shifts or twists away from our clients' long-term strategic asset allocations currently to more neutral stance from an asset allocation perspective. We still very much see the opportunities for outperformance, but it's going to be driven by the active management of the underlying fund or strategy rather than large shifts to the portfolio as a whole.
Thank you for setting the economic backdrop for this upcoming year, Cam. And with that, we will draw our webcast to a close. To our webcast audience, thank you for watching, and we hope that you found the conversation to be insightful. As a reminder, these quarterly webcasts are a great way for us to connect with our supporters from coast to coast, but they are not a substitute for a one-to-one conversation. We invite you to contact myself or another member of the client relationship team to schedule an in-depth discussion. On behalf of everyone at FGP, we wish you all the best for 2026.